What is up guys, my name is Ignas, welcome back to the channel. I'm currently checking exposures for market sectors of the Revolut dividend stock portfolio, and we now have a situation where there is not one sector in the red, meaning that we are close to those targets set. Still, there is a sector that I think should be the focus with next month's cash addition, that is financials. Currently we have $2,949.72 there. It is 14.27% of the portfolio with a target of 15%. So we are just below target, a good place to park some new cash into. But now I need to pick a stock to add cash into, and for that I'm picking 3 large banks from the financial sector. These are Bank of America ticker symbol BAC, Wells Fargo WFC, and Citigroup C. So I am picking these 3 names, and we'll do a dividend stock comparison to determine which one of these could be the best pick right now to add new money into. This comparison will be done under 8 different metrics. The metrics are positive revenue quarters over the last 5 years, current price to earnings ratio, number of shares outstanding, dividend yield, dividend payout ratio, years of consecutive dividend increases, 5-year compound annual dividend growth rate, and the current dividend yield compared to its 5-year average. So the best stock for the metric will get 3 points, second best 2 and the last one 1 point. We'll sum the results for all these 8 metrics, and in the end the stock with the most points will be considered the winner of this dividend comparison. I hope that the rules are clear and early thumbs up is greatly appreciated, and with that out of the way, let's start. So first metric we are taking a look into is revenue. Here we have information on Bank of America over the last 5 years. Back in 2020 they were bringing around $24 billion on the quarter, and in a year it was even lower at $22.6 billion. But afterwards 3 years were decent. In 2022 we saw a $25.2 billion quarter, an increase of 11.4% year over year, and 2023 the largest increase in the last 5 years to $43.4 billion, up 72.06%. Now going further, those increases went lower. 2024 again saw plus 11.8%, though the last 2 quarters again are in the negative, with the latest in 2025 being minus 3.84%. So in the last 5 years, Bank of America saw 14 positive revenue growth quarters. This is the information that we will be taking for the comparison. Now going to Wells Fargo. In 2020 they saw a decrease of 24% in quarterly revenue growth, being there at $20.2 billion. Then in a year in 2021 it was an increase to $21.16 billion. Though differently to Bank of America, 2022 was again a decrease, minus 13% to $18.4 billion. But similarly the largest increase in 2023, plus 53.3%, slowing on the gains by 2024 to $31.6 billion on the quarter. And now with the most recent quarter coming in, it is on minus 3.8% to $30.4 billion. So Wells Fargo is going a bit worse than Bank of America, with 12 positive growth quarters over the last 5 years. And lastly we have Citigroup. This is the stock that we currently have in the dividend portfolio. A similar decrease in 2020 minus 12% to $23.2 billion on the quarter. In a year it was lower another 15%, $19.7 billion. But then started moving up in 2022, plus 18% to $23 billion, the largest increase in 2023 to $37.5 billion plus 74.67%, 2024 again slower growth plus 16%, and with the last quarter in it is at almost zero growth minus 0.41%, a quarter of $42.35 billion. So not that great results here. Just 11 positive revenue quarters over the last 5 years. Now second metric we are taking a look into is the price to earnings ratio. So in 2020 Bank of America was trading at a P/E ratio of 10.04. It peaked in 2021 to 14.87, but then with earnings per share increasing, 2022 the P/E ratio went down to 10.72 and then continued moving lower, bottoming in 2023 at a P/E of 7.29. The last 2 years the stock price has been rising, with the P/E ratio also going up, and currently the stock is trading at 14.83, so pretty much the highest it has been over the last 5 years. Now Wells Fargo. In 2020 the P/E ratio was quite high at 38.54, peaking by the end of the year at 82.88, but afterwards we saw a huge spike in earnings. So 2021 PE already under 10, and this persisted for almost 3 years, where the stock price has started climbing faster. So in 2024 we have the PE ratio at 11.66, and now with the most recent quarter in 2025, the PE ratio is currently at 13.97. Doesn't seem too high, but also not the best we have seen in the last 5 years. And now Citigroup. In 2020 PE ratio is 7.43, jumping to 10.99 by the end of the year, but then for the next 2 years halving to almost 5, keeping on that to the second half of 2023, and then in 2024 we saw this earnings per share drop, with PE ratio skyrocketing to then 17.67. Now recently earnings per share is again higher, but the price is also moving up, so with the most recent quarter in, the PE ratio is at 14.71. Not the highest of the last 5 years, but we have seen it 3 times lower even 3 years back. Now let's take a look into the number of shares outstanding. So we have numbers for Bank of America over the last 5 years. In 2020 they had 8.76 billion shares out. After a year in 2021 it was 8.74 billion, but then we saw a better drop afterwards. So 2022 it was minus 6.56% year over year to 8.16 billion shares. 2023 8.08 billion. In 2024 it was already under 8 billion shares at 7.96. And now with the most recent quarter in 2025, that is another decrease of 3.88% to 7.65 billion shares out. So in the last 5 years, Bank of America decreased their number of shares out by around 12.7%. Now we have Wells Fargo. In 2020 their number of shares out was 4.1 billion. Interestingly, in 2021 we saw an increase of 1.22% to 4.16 billion shares. But afterwards decent decreases, so 2022 minus 8% to 3.8 billion, 2023 we have the number at 3.73 billion shares, 2024 another decrease of 6% to 3.49 billion, and now with the most recent quarter in again minus 6.3%, and the number of shares is 3.26 billion. So in the last 5 years, Wells Fargo decreased their number of shares out by 20.4%. And lastly, Citigroup. 2020 the number of shares out is 2.08 billion. In a year it is still quite up there at 2.07. Then a larger decrease in 2022, going under 2 billion at 1.96. Unfortunately a small increase in 2023, 1.97 billion. 2024 195 billion shares. And in the last quarter a larger decrease of almost 3% to 1.89 billion shares. So in this metric in the last 5 years, Citigroup did the worst out of the 3, decreasing the number of shares out by 9.2%. Now the next metric we are comparing is the dividend yield. So Bank of America is currently paying an annual dividend of $1.12 per share, and at a share price of $50.58, this is here a dividend yield of 2.21%. Now Wells Fargo, their dividend is $1.80, so at a price of $81.46 per share, we have exactly the same yield at 2.21%. And lastly, Citigroup, their dividend is $2.40, so at a price of $99.44, we here have the highest dividend yield at 2.41%. For the next metric we are taking the dividend payout ratio, so what part of company's earnings are used to pay dividends. For Bank of America the dividend payout ratio is now 26.22%, switching to Wells Fargo almost the same here. Payout ratio is 26.81%. And lastly Citigroup, with the lowest dividend payout ratio of the 3 at 24.38%. Metric number 6 is the number of years with consecutive dividend increases. So how many years in a row the company has been consistently increasing dividends. For Bank of America that is the last 12 years. Going to Wells Fargo they have been increasing the dividends for the last 5 years. And Citigroup now has the lowest result, with only 3 years of consecutive dividend increases. Metric number 7 is the compound annual dividend growth rate. We'll take a look into the 5-year estimate for next year. So for Bank of America, the 5-year dividend growth rate is 7.5%. Now Wells Fargo, and they have their 5-year dividend growth rate at a crazy number of 24.57%. And then Citigroup, with a way more modest one of 3.3%. So the last metric we are taking a look into is the dividend yield compared to its 5-year average. And for that we are using my dividend investing watch list on Google Sheets. We now here have the tab for Bank of America. Here is its dividend yield history over the last 5 years. And on average in 5 years the stock was trading at a dividend yield of 2.35%. So buying for the yield, the worst time to get in was back in 2021 with a dividend yield of 1.65%. Below average for 29.7%, and the best bet was 2023, a dividend of 3.31%, 40.98% higher than its 5-year average. Though buying the stock right now at a yield of 2.14% doesn't seem like that good of a deal, buying the stock 9.06% below its 5-year average. So this is here the number that we will be comparing. Now Wells Fargo. We have its dividend yield history over the last 5 years, and on average this stock was trading at a yield of 2.32%. So back in 2020 we have seen this crazy yield of 5.38%, more than 2 times higher than the 5-year average plus 132.09%, but they probably cut at it in next 2 quarters, because in 2021 it was 0.85%, below the 5-year average for 63.33%. Now after 4 years the stock is trading at a dividend yield of 2.1%, which is still below its 5-year average minus 9.44%. And lastly we have Citigroup, and from its 5-year dividend yield history, we have the average yield of 3.57%. So the best time to get into the stock was in 2020 at 4.84%, higher than the average for 35.39%, but it was very similar in 2023. Almost the same yield of 4.93. On the other hand, buying the stock right now at a dividend yield of 2.33%, it is way below average, pretty much the lowest yield we have seen in the last 5 years, under that 5-year average for minus 34.74%. So we have checked under all 8 metrics for these 3 stocks. I have the results in this table here, and now we can start assigning points. So Bank of America gets 3 points for the first metric, where they have seen 14 positive revenue growth quarters over the last 5 years. For price to earnings ratio, point goes to Wells Fargo, where they now have the lowest P ratio of 13.97. Metric for the shares outstanding again goes to Wells Fargo, where in the last 5 years they decreased the number of shares out by 20.4%. Dividend yield point goes to Citigroup, where the stock is now trading at the highest dividend yield of the 3 at 2.41%. Payout ratio again to Citigroup, because they assigned the lowest percentage of their earnings to dividends at 24.38%. Years of consecutive dividend increases metric goes to Bank of America, with 12 years of consistent dividend increases. 5-year compound annual dividend growth rate to Wells Fargo, with expectations of growing dividends and the compounded dividend growth rate of 24.57%. And now the last metric is dividend yield compared to its 5-year average. That goes down to Bank of America, where its current dividend yield is 9.06% lower than its 5-year average. Now that we have checked metrics and assigned points, we can calculate results. So Bank of America got 18 points, Wells Fargo also 18, and Citigroup only 13. This means that we currently have a tie between Bank of America and Wells Fargo, but if this number here is correct, a dividend growth rate of 24.57%, and also that they have been consistently decreasing the number of shares out, the largest here at minus 20.4%, so I would probably want to add 1 extra point for these metrics. And now with 19 points, Wells Fargo is considered the winner of this dividend comparison. Turns out it is definitely not Citigroup that I currently do have in the dividend portfolio. So that was it with today's dividend stock comparison. We have checked into a few banks from financials, and we have an idea where the new cash addition for next month should be going into. What do you think? Do you agree with this dividend comparison? Share your financial pick in a comment below. Also, don't forget to support the channel and leave a thumbs up under the video. Previously, I did an update on my dividend portfolio on Revolut, so if you are interested in that, then click on a video that is currently on the screen. And that was it from my side. Thank you for watching, and I'll see you all in the next one.